Hi, folks. Dan Bird here with the Daily Scan for Wednesday, December the 3rd. First off, I want to let everybody know that I am on a cruise next week, cruising the Southern Caribbean, leaving on Friday afternoon. So I will do a video tomorrow and Friday, and then I'll be out for 10 days. So the next week and a half, roughly. I'm not sure if I'll be able to do one. It'll depend on what the connection is like on the ship. If I can, I will, but there's no guarantee. So I just want everyone to know that. That includes the newsletter that I put out on the weekends and updating the website. All will be dependent on my internet connection. So we'll see how it goes. All right, topic for today: has the market topped? There's been some conversations, discussions, and videos out there that we are at the top or near the top. In particular, Tom Bowley, who I follow and I've learned a lot from. He's a great technician. He actually called the top in 2021, just before the 2022 long cyclical bear market. And he had a video yesterday. I'll show it to you when I get to that point, when we start talking about this topic, that implied that the market has topped and that he implied that he's gone to cash. So we'll talk about that, and I'll give you my interpretation of similar charts as what he showed using my charts. All right, so that's the topic for today. I'm going to very quickly go through where we are right now. I'm not a financial advisor, of course, so this is all for educational purposes only. Before I jump into that, let me show you from Stock Trader's Almanac what the market typically does. This is going back to 1950 for post-election years and 2004. So it's roughly about a 20-year period. 20 election years and 20 consecutive years. We are here right now, December the 3rd. Stock Trader's Almanac thinks it will be a choppy first half before a year-end rally. I will agree with that. I think that will be the case. And I'll talk about my perspective on that in a second. Of course, next week is really important. We've got the Fed meeting on the 10th in the afternoon, and in the morning is CPI. So both of those are going to be really important data points. And then jobs is on the 16th, probably the most important data point. And the same week as options expiration on the 19th. And you see the market choppy until that last one on the 19th. And notice also over here, the Santa rally. I talked about this before. The Santa rally was something that was coined by Stock Trader's Almanac years ago, and it incorporates the last 5 trading days of the year plus the first 2 trading days of the new year. The Santa rally is not the period from Halloween to Christmas. It is also not the period from Thanksgiving to Christmas. Everyone seemed to be talking about the Santa rally as if it's already begun. But the Santa rally does not officially start until New Year's Eve this year. 12/24 happens to be the first of the last 5 trading days of the year. So hold on, be patient. Santa rally is not here yet. That's where it's at right there. So that's what the rest of this month looks for December. And you can see right here, right around the 18th, 19th, we may start to rally into the new year. This is also the strongest period for small and mid caps too, by the way, which I'll show more of here in a second. So that's where we are right now. Let's go back over here and take a look at what the market is doing right now. Look at the 10-minute charts. And we shall see what's going on. See if we're still in that Darvas box channel. Well, we're starting to break out of it a little bit. Let me move it slightly over here. So we're now sitting right on the top of that channel. So perhaps getting ready to break out. So does that mean we are does that mean it's the top? That doesn't look like a top to me. It looks like a breakout to me, but we shall see. We'll talk more about that in a second. Technology is pretty much flat. Discretionary is up slightly, but flat. Communications flat. So that's the aggressive sectors. Defensive sectors also actually down slightly. So that gives a little bit of an edge to the bulls. And cyclical sectors, financials are up. Healthcare is flat. Industrials are up. Industrials and financials sometimes are in the aggressive sector. And materials is pretty much flat today, and energy's flat. So there's really nothing here, not much rotation going on. The market is just moving up based on technology stocks. The rotation growth versus value actually is down. It's flat for the day, but it's down from yesterday. Discretionary versus staples up slightly, and then flat. Technology pretty much flat. Semis are slightly up, and the transports are slightly up. So again, this is not really doing much other than just saying we're just moving, continuing to move sideways, just beginning to move out of the break out of the top of that box up there. There's breadth. Breadth's still looking good and moving up. That does not look like a top to me. Here's the Russell 2000. It had probably the strongest day of all of them. Money flow is really good. Definitely outperforming the S&P large caps. Mid caps are flat. Small caps is really where things are happening. Small caps is where the money is flowing to right now. Breadth looks great. In fact, percentage of mid caps above their 20-day is at 77% right now. And percentage of the small caps also at 77%. And then the NASDAQ 100 also moving up. This is where technology is. It has not quite broken out of its box. Let's put a box around this, just like Darvis would do. Of course, he didn't have computers back in his day, so he had to draw them himself. So this would be the Darvis box right now, last 2 days, basically. Not quite breaking out, but definitely moving higher. So that looks positive. Up volume, definitely positive. Advancers are outdoing decliners. The VIX is down. We'll look at all that here in a second too. And here's the breadth for NASDAQ 100. Looks great. 71% above the 20-day, 54% above the 50-day, and 58% above the 200. Bullish percent index moving up. That does not look like a top to me. So let's go back and take a look now at the index charts. First, I want to do that. So look at the S&P. S&P right now, you can see it is still above that downtrend line, which I talked about last week. We broke out of it on Friday. I said we probably would come back to it and then move sideways. That's exactly what's happening. As we're moving sideways, the 8 EMA is catching up. So probably once this catches up, maybe the end of the week, then this might actually break out to the upside and take out all these previous highs. In fact, it's very close to taking out this high right here. Let's see what the high is on this day. High was 68.69, call it 68.70, and the high today is 68.55. So 15 points more to go, and we'll take out this particular high. So that's still looking really good. That looks like a very positive, bullish momentum. Relative strength is moving up. It's above the 40 line. Money flow is still kind of lackadaisical down here, but notice the VIX. The VIX continues to move down. So the VIX is basically what the volatility looks like 30 days out into the future. And it's moving lower. So it's not telling you that there's going to be a lot of volatility, or another way to interpret that is selling in the next 30 days. That does not really look like a top to me. But having said that, it has not yet broken out. So we want it to keep moving higher. And actually, personally, I think we're going to go to 7,000, and that's where the top will be, right around 7,000. And that probably will happen at the end of the year, and we probably will stay up there, trade sideways for the first week or two into January until earnings start sometime in January. And then we might get a big pullback. That's what I think might happen. All right, so let's take a look real quick at the NASDAQ 100, see what it looks like. It's kind of looking the same. It has not broken out yet above these highs, but nice move today, higher. So the call wall and the put wall is right at the same place. In fact, by the way, the S&P call wall and put wall, this is where most of the options are accumulated, or where most of the open interest for options is. Right at 7,000, coincidentally, right exactly at 7,000. Both calls and puts. This is the reason why I think we're going to go to 7,000. It's going to act like a magnet. and why we probably will consolidate and move sideways once we get there. And then we'll see if we start to move down. I think that's going to be sometime in January when all of that happens. So we shall see. Keep an eye on that one. The other one to look at is Bitcoin. Let me look at the Russell first, because small caps and mid caps are the ones that have really been moving. You can see right there, it's got a nice candle. It is not quite breaking out above this high. This high was 248.81, and today the high is 249. So we did break out on the high. The close is 248.80. Close over here was 248.75. So if we close right now, we would actually have a new high on the Russell 2000, the mid caps and small caps. Still not back up to the previous all-time high back here, but definitely moving towards it. The call wall is right here. That's going to probably act as resistance. Or if we break through, then it might break through with a lot of power, frankly. But again, this does not look like a top to me. Now, finally, let's take a look at Bitcoin. And one of the comments that Tom made, I'm going to talk about his video here in a second, which he just put out yesterday morning, by the way, the 2nd. So it was yesterday morning. One of the comments that he made was Bitcoin is going down while the market was going higher, and Bitcoin is risk on. And that's implying that the market is getting ready to go down. Well, let's see what happened yesterday after he made his video. Bitcoin, I talked about this yesterday. Bitcoin created a bullish engulfing pattern after his video yesterday. And now it's continuing to move higher. So it's now above the 21 EMA. It still needs to break this downtrend line over here. But notice all of the momentum and everything is moving higher as well. So Bitcoin might actually start to move back up higher. I'm not sure what that would do to his thesis. So let's go back here and now talk about, by the way, for those that are subscribers, I have this market bias matrix, which basically are all of the asset classes that I track, all the indexes, sectors, industry groups, intermarket relationships, commodities, metals, and currencies. And I do this over here on a day over day, week over week, and you can see if it's higher day over day and week over week, it's green. We've got 3 greens and 1 yellow right now. But more importantly, this right here tracks or charts all of these asset classes over here. And notice what it's doing right now. It's sitting in this channel. It's been trading in this channel all the way back here to beginning of October is when it started. That was the high. Trading up and down inside this channel, and it's right now at the very top of the channel. If we close positive today, which I think we are going to, this likely is going to break out of the top of the channel, which would be actually very bullish. You can see the short term is already moving up. The medium term is starting to turn up right now, getting above 50% level. And the long term has just stayed up there. And actually, long term is moving up right now as well. So all of these, in fact, the medium term is the only one. Each of these columns, these are all of the asset classes for short term, all of the asset classes for medium term, and all of the asset classes for long term. Medium term is the only one that's yellow. Everything else is green. So all of this is very positive for the market. Continues to move higher. That does not look like a top to me. So now let's go take a look at what Tom Bowley talked about. So if you want to search for him on YouTube, just type in Tom Bowley right here. You'll get a bunch of his videos. By the way, one that he talked about last week. Let's see if it's in here. Calling tops. This is the one he did yesterday. So you can see 1 day ago. This is the video you should watch if you want to see what he said. Some of his quotes, I'll tell you some of his quotes from the beginning part of the video. He said, I'm not saying this is the top. I am not calling a top. I'm just highlighting increased risk. Is this a guaranteed top? No. Just risk off. So 2021 had a negative divergence for months before it rolled over. And he said the tops are much harder to call than bottoms, and I agree with that. Bottoms are much easier. So I encourage you to watch that video. He also had his, I don't know if here it is, Head and Shoulders. This one came out 9 days ago. So this is his head and shoulders video right here. And I'm going to start with that. Let's go take a look at the head and shoulders that I put on the website last week. In fact, right after his video about head and shoulders, because I wanted to look at it too. And right here, S&P head and shoulders, November 25. I'll probably type this out of here at some point, but this is what he talked about. Now, keep in mind, at the time of that video, it was 9 days ago. So we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. This little white candle right here. This is when he made the video. And the next day, the market dropped considerably, went right down to 65.50, which is a very important level. Keep 65.50 or 6,500, let's call it, nice round number. Keep that level in mind. But this is the head and shoulders that he said potentially was in the making. And I did a video on this as well. And I created this head and shoulders. There's the left shoulder, there's the head, there's the right shoulder. At the time, it had not made a right shoulder. The time I did my video, which was right after his, I think the next day, right here, I said that if it breaks through and does not make a right shoulder, then the whole head and shoulders is invalidated. And so this head and shoulders is now invalidated. It does not become a true head and shoulders until it breaks the neckline, which is this support line down here at about 6,500. If it were to do that, then a measured move would be from the top to the neckline and the same distance to the bottom, which would be 6,200. That would be the target if it had validated the head and shoulders, but it did not. It is invalid and no longer exists. But I just want to show this to you just as a reference point. Now, interestingly, 7,000 just happens to be the 61.8 Fibonacci level for November. The December fib level is just slightly below it. I think it's at 69.50. You can kind of see it right there in gray. Let me do this. So over here, this is the 61.8 right at 7,000. This is for October, or rather November. And this one right here is for December. So this one's actually at 69.75. So that's the level right now that is likely to be very solid resistance. So that's why I say that I think we're going to break out. In fact, it's already, S&P now is breaking out. It's probably going to break above this particular high. It might actually even break this high today, but I think it'll do it this week. And then it's going to, I think, head to 7,000. And then we're going, that's where the call wall and the put wall is, remember. I think we're going to hit major resistance. It's a nice round number. That's where there'll probably be a lot of sellers. And then we're going to decline from there, maybe bounce sideways for a while into mid-January. And then we may get that decline. So what I'm saying is Tom Bowley is a very good technician. He knows what he's doing. He says often, as I do, nobody knows what the market's going to do. The market will do whatever it will do. But you have to make sure to limit your risk. And that's basically what he was saying in that video, saying he was going to cash. Now, keep in mind that Tom is a short-term trader in generally. I'm sure he has some long positions as well, but in general, he's a short-term trader. So when he says he's going to cash, that doesn't mean he's going to stay in cash. He could very easily, if this breaks out right here, and especially if it breaks the recent high, he could very easily go right back into the market again, and nobody would know it unless he came onto a video and said, I'm not in cash anymore, I'm back in the market. He's a short-term trader. So you have to know what kind of trader you are. You have to determine whether you're medium-term, short-term, long-term. If you're in it for a buy and hold, you want to hold for the long term, then all of this is just noise. In fact, if the market goes down, just buy more, because over the long term, it will continue to go up. But keep that in mind with what Tom does. He is a short-term trader, so he could very easily get right back in again, and you may never know it. So that's also the danger of trying to follow a trader on YouTube. I've had people ask me if they could shadow my trades, and I am not going to do that, because everyone has their own way of trading, and you might get into a trade that I just happen to get into,
and you won't know that I'm out until it's too late. And you might not know for weeks or months that I'm out. So I will never do that. And I don't recommend anybody try to follow other people. Figure out your own method and make it your own and develop it that way. So anyway, one of the things that we always have to be concerned about and aware of is confirmation bias. So we may think that something is happening. I mean, this is obvious with this particular video that he did of a head and shoulders top. He was anticipating that this was going to be a head and shoulders. He was anticipating that the market was going to roll over and that the market was going to head lower. So he already perhaps has confirmation bias. So he is looking for reasons to validate that original narrative. Not to say that those reasons are right or wrong, just that we all have to be careful, including me, have to be careful of confirmation bias. We have to look at the data for what it is. And right now the data is saying the market is going higher, likely to 7,000. So let's go take a look at some charts here, some of them similar to Tom's charts, some of them my own, some of them actually, so everything I do is I've learned from other people. David Keller is a great teacher on the internet. He's another contributor on stock charts. I encourage you to go find his videos as well. I think actually there were some over here maybe. Dave Keller has some great videos that I would encourage you right here. Breakouts or trouble. So David Keller is another great one to follow and track. So I get ideas from him. I get ideas from Tom. I get ideas from a variety of places, and then I come up with my own ideas. And I get some actually from you guys, subscribers to the channel and to the website, have asked me to put certain types of charts on the website, which I really appreciate. All right, so what I'm going to do is I set up this, what I call the daily routine, where you can just step through all of these different charts. And you'll recognize some of these as Tom Bowley charts. You recognize some of them as David Keller charts. Some of them are my own charts. But I'm going to take a look at some of these. The first one we're going to look at is trend analysis. And I'm going to focus on the NASDAQ 100 primarily on most of these, maybe once in a while on the S&P. Trend analysis, this idea I got from Dave Keller. So what he does basically, he also has a short-term panel. I found that the short-term just moves up and down too much. It doesn't really add a lot of value for at least for the way that I trade. I'm not a day trader, but this is a medium term and a long term trend. And up here is money flow. And this one right here is the force indicator. I did a technical Tuesday on the force indicator. You go back and watch that. And of course, this is the NASDAQ 100 right here. So what you'll notice is the long-term trend had been coming down as the price was coming down. That normally is what happens. The medium-term trend actually went negative right here. So you'll notice, just look where the price is. It went below the 21 right on this red bar. That's right when the short-term went back positive briefly and then went negative again. And then the short-term or the medium-term trend continued lower as the price went lower. And then as the price started to go higher, right here, it crossed back over. So we are now back in a positive medium-term trend. That does not say to me that we are at the top. Now, could it roll over very quickly and move back below it again? Yes, of course it could. That's why this is called a daily routine. So just take a look at that and see where we're at. Keltner charts. Keltner channels basically show you the extremes that a stock could potentially move in. And I did a whole technical Tuesday on Keltner channels as well. There is an 8-day, and it's a 5-day moving average right here, the pink line. So Keltner channels, the green one is basically one ATR or one average true range. So the average that the NASDAQ 100 travels in one day. That's on average, that's what it does. That's up, 1 day up, 1 day down. That's the average range. The blue one is 2 times the ATR, 2 times the average range. The red one is 3 times the average range. And when it gets above the red one, it's 4 times or greater. That is at a very extreme level. Stocks and indexes usually don't stay there very long.
and they will eventually revert to the mean. We're back to the 21 EMA, the blue line right here. So what did we do here in October? We went up to the 3x, almost to the 4x level, reverted to the mean, came back down. We've traded down here to almost into the 3x, but definitely in the 2x extreme, and then traded above the 5 EMA, and now we're moving back up again. But we are still in the 1 ATR level. This is not an extreme yet. This is telling me that we are not done going up. This is not what you see at a top. You see this at a top right here, like we had at the end of October. This still has room to move. Could at least go to the 2x level right up here. So that's the way to use that one. Same thing with S&P. This is what the S&P looks like on the ATR, also just beginning to get out of the 1 ATR. And notice the ADX line is green. So the green is above the red. That means bulls are in control. So that does not tell me that we're near a top yet. Also, Russell 2000. This is mid and small caps. You can see now this is getting more into the extreme area, but it's still not in the extreme level. It has to get up, would have to get up here above the blue, in between the blue and the red, to really be on an extreme like it was back here. And then it reverted to the mean, and then traded sideways and went back up and reverted to the mean. So that's how it works. It comes down to an extreme level and then reverts to the mean, goes right back up again. All right, so let's next take a look. Here's my 10-minute charts. Let's look at rotation ratios. These are ones that Tom Bowley showed. And I'm going to show the similar ones here. So, but I've included the RSI and the money flow lines on here as well. Make this a little bit bigger. All right, so first off, this pink horizontal line is the 40 level. In a bullish trend, even if there are pullbacks, typically a stock will stay above that 40 line. You can see it dip below it slightly right here, but the relative strength went back above 40, and it's now moving higher. It is not yet overbought, so it's not at an extreme, and it's moving up towards 70. So that's what you like to see in a bullish move. It's getting ready to break out of this particular high back here. Discretionary versus staples. So he talked about these. He said, "Oh, discretionary versus staples. It's very tepid. It can't get back up. It's trying to get back up, but it's really not doing very much." Well, I would argue with that because the market was going down too. And when the market goes down, this typically will go down. Same thing with growth versus value. If the market is trending lower, then usually growth is underperforming value. It's trending lower as well. What you really want to see is when the market is going up, if this goes down. That is a negative divergence. Those are the kinds of things you want to look for. Like right back here. If we look at the growth versus value down here, the market right here was moving higher, continuing to move higher, but growth versus value was going down. Why wasn't that the top? Why couldn't that have been the top? So right now, I think it's doing exactly what it should be doing. Now, would it be nice for it to be just as strong as it was back here? Since we're getting close to that same level, yes, that would be ideal, but it is moving that way. And it very well could get back to that level. The NASDAQ versus the S&P, pulling back slightly, but it's moving higher. It's above the moving average line. That's a 21 EMA, by the way. Technology versus the S&P, it's sitting right on the 21 EMA. So it's not really moving as much as you would like to see it move. Growth versus value is continuing to go down. In fact, it's actually rolling over right now. So the rotation, this one here definitely shows you that the rotation is out of growth and into value, even as the market tries to keep going higher. Now the market is lower since this point right back here. So if we look at this point here, right here, which is almost where we are right now, do it this way. Look at this point right here on growth versus value, which is almost to what we're back to. Yes, we're definitely not back to that level. Doesn't mean we won't get there, but we are not at that level right now. And that's what you would like to see. If growth is outperforming value, then this line should be at least up to the same level as it was when we hit that high right here. and it's just slightly below it. And then the small and mid caps versus the large cap tech is starting to move higher, which is typically what it does at this time of year. So there definitely are some indications that the market is getting tired, that it may be losing momentum, but I don't think it's quite there yet. Now, from Tom's perspective, and I want to reiterate this, he's a short-term trader. So for him, this is enough to say, I'm just going to sit it out. I'm going to sit on the sidelines and just wait to see what it does. This, especially growth versus value, not keeping up with the price. So probably a very good move for him to do that. Does that mean he won't get back in if it does break through this right here, especially if growth versus value and discretionary starts to take off? He easily could get back in, and that could be next week that he does that. You just don't know. But for now, it probably is a prudent move just to step aside and wait and let the market prove itself. All right, let's go down to the next level here and look at rotation and momentum. This is one that I created. This shows you down here the discretionary versus staples. Again, this is the high from back here in January before the big sell-off in February. So that's what these horizontal lines are. You can see that we are back to the same level we were back there in February, even though the price is actually higher than that right now. But it's just the discretionary versus staples to me is just moving sideways and starting to move back up. Equal weight discretionary versus equal weight staples. So this takes out the cap weighted component of this comparison, and it is moving sideways and starting to move higher. Growth versus value, as I showed you before, is definitely moving lower right now, has not broken below this previous high, which it actually did right here during this period. But that's the one concerning area. Transports are moving up, looking really good, and then the S&P cap weighted versus equal weighted is moving down, which means those big cap weighted stocks that were driving the market higher previously are not moving it as much. The equal weight now, other stocks and other sectors are moving it at least just as much as the cap weighted ones. Now, one thing that I created is this momentum chart right here, which essentially are two MACD. Think of it as two MACD lines. One is a longer term and one is a shorter term. And whenever they cross right there and right there, that's usually a good confirmation. It's not an early warning, but it's a good confirmation that the market is going lower or going higher. And you can see it's crossed to the upside right here. And it doesn't even look like it's rolling over yet. It's continuing to move up. You can see what happened back here when it crossed to the downside right here. By the way, during this period, the beginning of this year, we continually hit two higher highs before the market finally rolled over. And I was talking about the distribution area. Basically, the market had been moving sideways for 3 months since December, right into February. And I said at the time that it looked like a distribution phase after a big run higher, and that we likely were going to go into a markdown phase, which is just exactly what we did. But this is the momentum indicator that I created right here. This is the confirmation of the downtrend, this vertical blue line, and this is the confirmation of the uptrend when it crossed back over right there. Right now, it is moving higher, telling me that we still have a little bit left in this rally. All right, what's next? Cap weighted versus equal weight. This shows you, so this is the weighting up here, and this is the SPY. This is equal weighted SPY. So you clearly see the cap weighted is still outperforming the equal weighted. This is the relative chart here that shows that the cap weighted is still moving higher. So cap weighted is still driving the market higher. Same thing with the NASDAQ 100. Here's the equal weighted, here's the cap weighted. Now in this case, the technology stocks, which were the ones that were really driving the market, now all of the stocks are really moving it up. And this one is still moving higher, but it's sitting right on the moving average line. So this looks like it's losing momentum right now as well. So those are the large cap tech names that might be running out of steam. XLY versus XLP, better view of this one. This is a chart that I created. Make this a little bit smaller. So you can see up here, the S&P has not quite made it back up to that level. Here's the weightings. So Amazon, XLY, Amazon and Tesla make up 43% of the XLY. Whereas, in fact, the top 5 make up 58%. Top 5 make up 58% of the weighting of the XLY, whereas the top 5 over here make up 40%. So much different weighting between XLY and XLP, but XLY right now is pretty much moving sideways, XLY versus XLP. So the relationship between them is moving sideways, but it's actually increasing and moving up. Discretionary versus staples down here. This is equal weight for both. And you can see on the equal weight side, which takes, basically weights all of these the same percentage, is actually doing a little bit better than the cap weighted one. So the rest of the stocks, rotation is out of the big cap stocks and into all of the other ones. Here's the momentum that I talked about. This is my momentum graph right here. It's just now moving up into positive territory. So it did move lower right here when the market was selling off. It's now moving back up into positive territory. And this is basically starting all of these. This is a 2-year and 4-month chart. It's starting all of these at the same place 2 years and 4 months ago. And discretionary clearly is outperforming staples. Staples continually underperforms. So that I would say the jury is out on this one. I would say we are still in a bullish trend in general, but perhaps running out of steam. All right, let's look at breadth. So breadth analysis. Breadth is what I showed you before. This is the advanced decline line. So this is the NDX advanced decline line. As the market now is moving higher, you can see there are as many advancers, or there are more advancers than there are decliners. And this is getting back to the same level that we were at before. So that is good breadth. Here's the New York Stock Exchange advanced decline line. This one is slightly lower over time, so but not significantly so. So that could be running out of steam there. S&P large cap advanced decline line is definitely moving higher. So the large caps are carrying it. Mid cap, and same thing. It's moving up, but it's basically right at a little bit lower than this level here. And then the small caps down here are still at a downtrend, overall downtrend. So there are more advancers than decliners in these categories, but it is not outperforming from where it was previously back here. Again, a sign that the market might be running out of steam a little bit, but definitely not getting ready to roll over just yet. All right, intermarket breadth analysis shows you the NASDAQ versus the S&P. The NASDAQ is still carrying things. It's above the moving average line. Growth versus value, this one is the one. This is probably the most concerning one right here. The trend seems to be out of growth and into value. This is what happened at the end of 2021 before a long cyclical bear market cycle. It was much more pronounced than this, however. It wasn't hugging this horizontal line. It was actually going much lower. But this is lower, so the market is probably running out of steam, or it's becoming more defensive. Think of it that way. They're moving, big traders are moving out of the big cap tech stocks and moving into some of the more value-oriented stocks. Discretionary versus staples, we looked at before. Here's mid cap and small cap, both of them continuing to go down, but small caps actually are perking up and just broke their downtrend line right there. So small caps looks like the place to go. Advanced decline lines just shows you up here the New York Stock Exchange, NASDAQ 100, and the NASDAQ. Advanced decline lines continuing to move up. And down here is the actual advanced decline lines. I would not put much stock in the NASDAQ. I would use the NASDAQ 100 instead. And that's because the NASDAQ advanced decline lines, this explains it right here. Advanced decline statistics favor small cap and mid cap over large cap stocks. Thousands of stocks trade in the NASDAQ. Vast majority of these stocks are small and mid cap. Relatively few are large caps, regardless of market cap or volume. An advance counts as +1 and a decline counts as -1. So even stocks that go out of business and are delisted are still captured in this NASDAQ advanced decline line. I would not pay any attention to that one. Use the NASDAQ 100 and the New York Stock Exchange. It's much better indicators. Bullish percent index. This is the percentage of stocks that have bullish configurations. And this is the S&P up here, breaking the downtrend line, and it's above 50%. And this is the NASDAQ 100 above 50% and almost getting ready to break the downtrend line. So if that does break the downtrend line, then that's going to be bullish as well. And we're trading sideways in this channel, just like we typically do at the top of a run. I've showed you the Wyckoff market cycles. This is the distribution phase. Distribution phases can last for weeks or months. At some point, it's going to break down through that 6,500 level. And when it does, that will probably be the beginning of the markdown phase. But I think we're going to 7,000 before that happens. But it will happen. McClellan oscillators, these are, I'll show you the NASDAQ one. McClellan oscillator is simply a moving average of the advanced decline lines. If it's above zero, then the market has more advancers than decliners. And that's where we are right now. Definitely more advancers than decliners. Here's the bullish percent index. You can see right now it's at 60% and moving higher. So there are more stocks that have bullish configurations right now, and we are not back to the highs yet. So if we do continue to go up and get back to these highs, this is going to continue to stay green. It is not below zero right now. So when it went below zero right here, this is a good example. When it went below zero right here, that was the top. That was the absolute top right there. And then we trended down all the way down here to the bottom, and then advancers went positive right here, and we have not gone back down to zero. So we are not yet ready to roll over. Can we roll over? Sure, we absolutely could. And that it could happen very quickly. But right now, there's no indication that's going to happen. I think it probably will in January. If we look at the VIX, I've talked about the VIX before many times, and you can see right now the VIX, not only is it below 17, but it's continuing to go lower. So the VIX is a projection 30 days out of what the volatility of options will be. So this is telling us that over the next 30 days, it's going to be very calm. There won't be a lot of selling. Right now, we're back up at the top of this green bar, and the 10-day moving average put-call ratio, which I'm going to talk about that in a second because Tom talked about it in his video as well. 10-day moving average of the put-call ratio, this is a close-in view of it. So if it's moving up, that means there are more puts than calls, and it typically happens when the market is moving down, like right there. But when we get up to this level, especially this pink line right here, which is 0.70, that means there are way more puts than there are calls. That means everyone is bearish. Everyone is expecting a sell-off. Everyone is expecting that we're at the top, and everyone's buying puts. But that usually is the point where the market, this reverses, and as this starts to come down, the market goes higher. 10-year Treasury is still moving lower. If we get a rate cut next week, that's going to be very positive for the market as well. So let's look at the put-call ratio. So the first one I'm going to show you is Tom's chart that he showed, or very similar to his, for the 253-day put-call ratio. This is a long-term put-call ratio. So keep in mind puts versus calls. So if it's moving down, that means it's positive. So you can see right here, and he pointed this out, that we had two lows right here, a low in 2011, and we had a low in 2014. That means there were more calls than puts. If this is moving up, then there are more puts than calls. And in both of these cases, now I put a line, a vertical line, just to help you visualize it. Because one of the things I noticed sometimes, especially with long-term charts like this, and Tom did this on his video as well, they'll have a habit of saying, see, it reached a low right there, and then the market rolled over. Reached a low right there, and then the market had a little downtrend right there. Reached a low right there, and then the market had a downtrend right here in 2018. Now, this was COVID, so this was all buyers, so you should expect for it to hit a low. Hit a low right here, but the market really didn't go down. It went down a little bit, and then this went back up and went down and hit another low in 21. Now, the 21 low was just before that 2022 cyclical bear market.
And this is the one that he points to, saying that that is the indication that the market is getting ready to roll over. And it can be, absolutely can be an indication. Now, what about this one? Well, it took about 3 or 4 months before it actually rolled over. What about this one right here? This one really didn't, it went down slightly, but this took about 2 months before it happened and didn't really go down much. What about this one? This one really didn't go down in that particular case. So this is where we are right now. So what about this one? What are we going to do? Well, we're going to find out soon. But in this particular case, you notice the VIX down here. So let's look at this. This one here, the one just before 2022, because it's the best example to point to. This one started to move up, which means the market is getting ready to roll over, which it did in 22 for almost the whole year. But where was the VIX? The VIX at that time was sitting right at 20. The VIX right now is below 20. This is a 253-day VIX, by the way. So in this case, the VIX was actually moving lower over here, and the VIX right now is a little lower than that. So it doesn't quite look the same as it did back here. We'll see. And then I put some Fibonacci levels right up here, 2 Fibonacci levels. This is what I like to do. I did one. The gray one is from the peak up here to the very bottom right there. And the green one is from these 2 peaks right here down to the bottom. And where the 2 of them cross, you can see that those are very key levels right through here. And this one is actually not quite down to the 61.8 level. So this one could very easily reverse and go back down before we actually get that final bottom. So does the market look like it is running out of steam? Yes. Does it look like it potentially could be nearing a top? Maybe. Is that enough to want to go to cash? Depends on what your trading style is. So let's look at a closer in view, the 10-day moving average of the put call ratio. Now in this case, you can see this goes back 3 years. So the put call ratio, when it gets up here near this pink line, this is the 72 line. So I put some green vertical lines right there. That's usually when we get to a bottom. Right here, this was in 25. This is the April bottom. It got close to there. This one right here was 24 after a sell-off. This one right here, we'd already started to move higher. The red ones are when it's all the way down. So there are more calls than puts, meaning everyone is bullish down here at the bottom. And that usually is where tops happen. So this one went down, kind of was a top, didn't go down. It went down a little bit, not a lot. This one right here in October, this was about 2 months before. This is about a week or so before our top. This is a daily chart. And then the market rolled over a little bit. Never went below the moving average line. This is a 50-day moving average. And then it hit down here again in November. And that time we did go down below the 50 and went back up. But where are we right now? We're at the top. So what happens at the top is usually it's a green line. The green line means that there are too many people are bearish, that they're getting ready to the market's actually getting ready to go back up. And this will then start to trend this line downward. You can see right there when this gets to the peak. That's where we are right now. This to me looks like perfect setup into the end of the year for a nice rally to 7,000 by the end of the year. All right, let's take a look then at risk on, risk off chart. This basically just shows you, this is the S&P, it's pretty much flat across here, trying to make a new high. The relative strength is trending lower, so that is a negative divergence for sure. Ever since August of last year, continues to make lower highs, so that negative divergence exists. Junk bonds versus 20-year treasury. This is the risk on, risk off chart. You can see it was trending lower as the market was going higher. So it was the traders, Wall Street traders were potentially going risk off. But look what's happened right now. It's actually broken that downtrend line. And there's a little bit more risk on right now. Junk bonds versus high yield corporate bonds. This one was trending lower as well. But it is now broken that downtrend line.
What about high yield corporate versus 7 to 10 year treasuries? Well, it has not yet broken the downtrend line, but it's traded right back up to it. And then, of course, the ones we've already looked at, growth versus value continues to go down, but right now it's kind of flat, going sideways. And discretionary versus staples was definitely trending lower all the way for the month of November, basically. Trending lower for November, but in December, look what's happened. It's starting to trend a little bit higher. So does this say that we are currently at a top? I don't think we're there yet, but we could be headed there. All right, what else do we got? 50-day, 50 and 200-day. Here's the put call ratio. You can see right here, it's in the green, which is the point where the put call ratio reverses and starts to go lower, and that is when the market rallies. When the put call ratio trends down, the market will trend up. Notice the RSI is going up, moving. Money flow is moving up. Percentage of stocks above their 20 are just breaking that downtrend line right there. Percentage of stocks above the 50 have not yet reached the downtrend line, but they're above 50%. Percentage above the 200 have broken the downtrend line, and bullish percent index has also broken its downtrend line and is moving higher. It's above 50%. So this implies that overall breadth looks pretty good. Put call ratio is probably will cooperate into the end of the year and give us continue the bullish rally into the end of the year until this put call ratio pulls all the way back down here. That's where the top will likely be. By the way, you can see how you can identify bottoms more easily than tops. It's very easy to do with that particular one. And then finally, bullish percent index right here. You can see the NASDAQ bullish percent index is above 50%. It's actually hitting the downtrend line right now today. If this continues to go higher, if the NASDAQ 100 continues to go higher, the bullish percent index or the number of stocks, the percentage of stocks with bullish configurations will actually break this downtrend line. And that will help push the rally even higher. So we are sitting right at a point right now where probably a good decision point where the market's going to determine whether we rally into the end of the year, which is what I think will happen, or we're going to roll over. Now, will we roll over? Yes, at some point we will. I think the beginning of 26 is going to be really rough. I think we're going to have a big downtrend the beginning of 26. I still think we're going to rally into the end of the year, hit 7,000. I think we will overall next year have a bullish year by the end, but the beginning of the year is going to be really rough, just pretty much like it was this year. So if we look at up here on the Santa Rally chart for 25, you can see the Santa Rally, 2 out of 3 were positive. Right here, this vertical line is January 1st. The market rallied up here into the end of February and then fell all the way down here. And when this fell all the way to the bottom, I'm sure everybody at this particular point was saying we're at 40 below 5,000, basically. We were below 5,000 right here in April. And I'm sure everybody at that time was saying there's no way we'll get to 7,000 in 7 or 8 months. But here we are. 7,000 is right up here. It's that would be a 43% gain off of the bottom if we get to 7,000. But I think there's a good chance that we will. So my conclusion is the market looks like it's getting tired. It's running out of steam, but it's not done yet. I think that there will be a rally into the end of the year, and then we will roll over. But everyone has to understand their own trading style. That's the most important thing. Recognize whether you have confirmation bias. In other words, you're trying to confirm what you think might happen. Recognize that. It's a very hard thing to do. And just follow your rules. Follow your rules for risk management. I did a whole risk management session on Tuesday. Follow your rules on that. If nothing else, you can follow the MTS strategy over here, which right now is still long, and just stay in the market. Don't even worry about it. Stay in the market until this changes to cash. And this gets updated every day. Will you hit the top? Absolutely not. If it turns to cash, will you make 21%? No, probably not. You might make 16%, but you're not going to lose 40% or 20% or even 5%. You're still going to make money. You just will not get the absolute top. So even if you went to cash today, like Tom said that he did, the market may still have a nice run ahead of it moving up. And then it may roll over. And the rules, the target for this particular strategy right here, will get you out at pretty much the same place where Tom got out himself yesterday. So yes, he'll sit on the sidelines as the market rallies up and he'll watch it move back down, knowing that that is actually the top. At some point it will be. This strategy will do the same thing for you. It may get you out at exactly the same place as Tom got out, went to cash yesterday. Might be a little bit higher. We don't know. But this basically is just a rule-based system that's very easy to follow and easy to track. All right, sorry for the long one today. Let me know if you have any questions, comments, anything you want me to look at. And remember, I'm out starting next week. I will be cruising the Caribbean, and but I will be here tomorrow and Friday. All right, thanks for watching. Please like and subscribe, and I'll catch you later.